Hi, everybody. This is the first of a two-part series on inflation. Part one will look at measuring inflation and inflation expectations. My name is David Gully. I'm from Bentley University. Please visit our YouTube channel, Bentley University EC391, for many, many videos on monetary policy and macroeconomics. Our agenda today is pretty simple. We're going to look at how inflation is measured and how inflation expectations are measured. In part two, we'll look at what are called inflation dynamics. These are aggregate supply and aggregate demand factors that are currently impacting inflation. There's lots of action on this front. So we'll start with the standard measures of inflation. Inflation is typically measured by the percentage change in a price index. In the United States, we have two notable price indices. The first is the Consumer Price Index, the CPI. That's a basket of goods and services that the typical household buys, and that's constructed by the Bureau of Labor Statistics. They periodically survey households and ask them what they actually buy, so they construct the basket based on actual household behavior. Several problems with this, however. The basket is relatively narrow, and it doesn't get updated particularly frequently, every few years. On the other hand, the personal consumption expenditure measure of inflation, the PCE, that's updated effectively every quarter or even every month, and it's much broader than CPI. So, for example, the definition of GDP on the expenditure side is C plus I plus P plus NX, consumption, investment, government spending, and net exports. And so the PCE index captures all the goods and services that we actually do buy. So it is effectively a real-time basket. So it's much more real-time and much broader than is the CPI. And as a consequence, it's less variable and it's often lower than the CPI inflation. We'll have a visual on this in a minute. And then as a consequence, the Fed follows this version more closely in terms of making its policy decisions. Each measure also has a headline figure that's includes all goods and services, and then what's called a core figure that excludes food prices and energy prices because those are typically relatively volatile, as we'll see in a second. And so here's a time series of the CPI. This is the headline and the core. The solid blue line is the headline figure. The solid red line is the core. So you can see if you exclude food and energy, the CPI index is much less variable. And for the most part, until the pandemic, they stay roughly at the same level. But as you can see here, post-pandemic, apologies for the technical glitch. There we go. The solid blue line there, the headline, increased much more rapidly than the core figure. And that is, of course, because of relatively higher food and energy prices. So you can see on the margin in the last few months, each has been coming down. So along with the data that the Bureau of Labor Statistics releases, they include this very handy chart. And so these are the last 13 monthly inflation rates. And so, of course, if you take the last 12 of them, you calculate the annual inflation rate. And so you can see that on the margin, the last 5 months, the inflation rate on the monthly basis has declined pretty notably. And so what will happen is that over time, as these relatively high monthly figures are dropped, then you can see that the annual CPI inflation rate will decline pretty noticeably. For example, in the most recent report in November 2022, is the data dropped the 0.7% increase and added the 0.1% increase. And so that brought the average annual inflation rate down. So again, as those relatively high monthly rates are dropped, the annual rate will decline pretty precipitously. So here's the PCE inflation measure. So it follows the same general trend. The solid blue line is the headline figure. Again, the solid red line is the core figure, excluding food and energy. You see, until the pandemic, they move pretty closely together, though again, the core is less variable. But just like the CPI, the headline figure on the PCE increases more rapidly due to food and energy. But notice here over on the vertical axis, the overall level of the PCE inflation rate is lower, notably lower than is the CPI. And again, this is based on the fact that it's a broader index and includes the goods and services that households actually buy. And so what we can do is we can break down inflation using the CPI by goods and services. So the solid blue line here represents inflation of services. Solid red line represents inflation of goods. And so, for example, you can see that for a very long time here in the mid-2010s, that the goods CPI measure was roughly flat. And that's driven by competition in manufacturing, increasing productivity in the production of durable goods and services and things like this. However, post-pandemic, as everybody went out to try to buy HD TVs and washing machines and auto wheels and so forth, the prices of these goods increased very dramatically. Now you can see that in the last few months, they've started to fall off. However, what people have done on average, not everybody, but on average, is we've started moving more toward purchasing services. So this is, we're taking vacations, we're booking flights, we're staying in hotels and so forth. And so as a consequence, services inflation has started to rise very notably. Breaking services down, this is from the Dallas Fed, into its various components, you can see in the light blue area right here, that's transportation, recreation, accommodation, food. That's effectively taking vacations, for example, going on business trips and so forth. And then the dark blue area here, that's housing services. That's rent from people who rent apartments, and that's effectively called owner's occupied rent, or owner's imputed rent rather, and that measures the rent that homeowners would pay if they were renting the home that they own. It's slightly convoluted, but what economists have to do is include the implied prices from people who own their own homes. Otherwise, we'd only be measuring the prices of rents from people who rent their home or rent their apartment. So we want to have as broad a measure of housing services as we possibly can. And so notice that both of those have been outsized influencers on services inflation, especially in 2022. And so these are really very, very helpful measures of inflation, of course, but they might not tell the entire story. And so what we want to do here is look at three different measures of inflation. So we'll look at the Dallas Fed's version of the trimmed mean PCE inflation, the Atlanta Fed's sticky versus flexible price inflation rate, and the New York Fed's underlying inflation gauge. So let's look at the trimmed PCE mean first. So the problem with any average is averages are impacted by outliers, either on the high side or the low side. And so if you're worried about these outliers, what you might be able to do is drop them and remove them and then recalculate the average. So the Dallas Fed ranks all the price changes of all the goods and services that go into the PCE from the lowest to the highest. It drops the lowest 24% and drops the highest 31%. So that effectively what they're doing is they take the 45% of goods and services right in the middle of the distribution and track those changes, and they drop the highest and the lowest values. And so you can see here that the solid red line, this is the headline PCE measure. The solid blue line is the trimmed mean PCE measure. So this is effectively right here looking at the inflation rate in the center of the distribution of all goods and services. And you can see for the most part, they trend along together pretty well, with the trimmed mean PCE being less variable, which is unsurprising because the highest and the lowest values are removed in the calculation. But that notice, even still, it's increased very dramatically and accelerated much higher than the Fed's 2% inflation target. There are also a number of different pricing dynamics, meaning goods and services don't change prices all at the same rate at the same time. So consider, some goods and services are produced in very, very competitive markets. In highly competitive markets, price changes are more likely to become or to be more frequent. Other goods and services are traded in markets that might not be so competitive. And as a consequence, those prices do not change very frequently. So particular examples, consider how quickly the prices of retail gasoline changes, fruits and vegetable at the grocery store, dairy items, milk and eggs and things like this. So these change very rapidly. On the other hand, prices, for example, of doctor visits, rents, for example, those only change once per year for people who are going on a year-to-year rental contract, and for example, public transportation, subways, and so forth. These change very, very infrequently. Sometimes months or perhaps even years go by before these prices adjust. And so what the Atlanta Fed has done is they've built an index of each: prices that tend to change relatively rapidly, prices of goods and services that don't change very rapidly. And so and this should not be too surprising, the gray line here, that's the flexible price index. Those are prices of goods and services that change frequently. The yellow line, prices of goods and services that don't change so frequently. And so notice that initially there's a giant increase in the flexible price CPI, but that has now started to fall very dramatically. But then the sticky price CPI, notice this has started to increase notably, but it's increasing at a relatively slower rate. And notice in the last couple of months, it's flattened just a little bit. So what this suggests is that pricing pressures may be starting to ease notably here. And then finally, we have the Federal Reserve of New York's underlying inflation gauge. And this is somewhat more complicated here because it includes variables that are not directly price indices. So it includes asset prices, like, for example, changes in interest rates, and includes real variables, say the unemployment rate, for example. And these variables are correlated with the CPI and the PCE inflation rates. And so what the New York Fed is doing here is they're including variables that are related to or correlated with headline inflation. And so what happens then is that the underlying inflation gauge does a pretty good job of forecasting future headline inflation. And so let's have a look at the data here. And so the gold line, the kind of yellow line here, that's CPI inflation. The blue line right here, that is the underlying inflation gauge. That's the full data set measure. That includes, for example, interest rates, the unemployment rate, and other real variables that are correlated with the headline inflation rate of the CPI. And so the point here is that it captures other factors that may be driving the headline inflation rate. So you can see that the underlying inflation gauge here from the New York Fed has started to trend down. And so this is indicating that variables that are related to the headline CPI are starting to push the CPI downward. And you can see that up here again as the CPI starts to decline. So now let's turn our attention to inflation expectations. The Fed pays a great deal of attention to expected inflation. And the idea behind this is that higher expected inflation, for example, can be associated with higher actual inflation. So at the aggregate macroeconomic level, inflations can be self-fulfilling. So for example, if people expect prices to increase, they might go out and buy more goods and services, or at least try to, before prices increase. And if enough people do that, actual goods and service prices will tend to increase. So we'll all think we're a bunch of Nostradamuses. So the idea here is that the Fed wants inflation to be what they refer to, so this is right out of their dictionary here, wants to be well anchored so that our expectations help prevent actual inflation from increasing too much. There are several general ways you can measure inflation expectations. One are survey-based measure, just ask people, and these can be randomly selected people in the street, or they can be professional forecasters. We also have what are referred to as market-based measures. And so these are measures of expected inflation that are inferred by or calculated from prices of various financial assets. So the New York Fed has a survey of consumer expectations, very clever name, yes? And so they ask households on a monthly basis what they think inflation rates will be 1 year ahead, 3 years ahead, and then 5 years ahead. They just started doing this very recently. And so the solid blue line there is the 1 year ahead measure of expected inflation. The solid red line is 3 years. This little solid gold line there, that's the 5 year. Again, they just started that. And so you can see that in 2022 here, early 2022, the expected inflation rate a year ahead increased very dramatically. And this was very concerning to the Fed. But notice that the 3 year and now the 5 year have not caught up. So what this suggests is that people expect that the current high rate of inflation is not going to last for a particularly long period of time. And notice even here in the last 3 or 4 months, the average expected inflation rate over the next year has fallen pretty notably. What's important to note here is that on average, higher expected inflation rates are also more volatile. And more volatile inflation rates are harder to forecast or harder to predict. And so what the New York Fed also does is they also measure inflation uncertainty. And so this is effectively a dispersion measure of how widely apart or how far apart the various households, when they are asked, gee, what do you think inflation will be over the next year, how dispersed those responses are. So if everybody agrees, the uncertainty measure is low. If there's lots of disagreement, the uncertainty measure is relatively high. And so you can see that in the last couple of years, there's been a pretty substantial increase in the uncertainty in terms of households find it more difficult to predict what inflation will be because there's a lot of interesting inflation dynamics going on, and we'll discuss that in part 2. You can also ask professional forecasters. So this is the Philly Fed survey of professional forecasters from November 2022. So the blue lines there are from the most current survey. The red bars, those are from the August 2022 survey. And so they asked, well, what do you think inflation will be over the next year, 2023? And so notice here that there's been a little bit of shift in the distribution toward a relatively higher expected inflation rate. So some of the distribution has shifted away from relatively low inflation rates and shifted toward relatively high inflation rates. And then finally, we'll take a look at a market-based measure here. It's called the 5-year break-even rate. And so what this is, how this is calculated is it takes a look at 2 separate 5-year U.S. Treasury notes. So the first note, is a standard 5-year Treasury note. These are issued, they have a 5-year maturity, they pay interest each year, and then the face value is paid off at the end of 5 years. And so if we use the standard Fisher equation, that breaks nominal interest rates down into 2 components. So there's a real component and there's an inflation premium. So the idea of the inflation premium is that over the 5-year time horizon of this note is that the bondholder will want to protect themselves against the inflation rate that they expect so that those cash flows that they receive are compensated for the relatively high or low inflation rate that they expect over the lifetime of that security. The other Treasury security is the Treasury Inflation Protected Security, cleverly called TIPS. So here's the difference between the two. In the standard note, in the run-of-the-mill standard 5-year Treasury note, all the cash flows are fixed, the annual interest payments and the face value that's received in 5 years when the note matures. But the cash flows from the TIPS, those are adjusted by changes in the CPI. So if the consumer price index rises by 10% in a year, let's say, the annual interest payments are increased by 10%, and the face value is increased by, say, 10%. And so the reason this is important is that if you look at the Fisher equation, part of the nominal interest rate is an inflation premium, protection against expected inflation. Given that the TIPS security automatically protects the holder against inflation, it doesn't need or doesn't require an inflation premium. It's built right into the cash flow. And so as a consequence, the nominal rate on the TIPS security is just a real interest rate. So you simply look this up online and you see the interest rate on that TIPS security, that's a real rate. And you know it's a real rate because you don't need the inflation premium, and you don't need the inflation premium because the cash flows are automatically adjusted for any change in the inflation rate. And so what happens then is if the standard 5-year Treasury and the 5-year TIPS security are equivalent in all ways, then the real interest rate on the TIPS security is a stand-in for the real interest rate on the standard note. Now, just as an aside here, there are some differences. Most notably is that the standard Treasury security is more liquid than the TIPS security. So that results in a little bit of price differences. So the expected inflation rate isn't 100% accurate, but it's a pretty good indicator of what financial markets think the expected inflation rate will be. So anyways, so now that we know that the interest rate on a tip security is effectively a real interest rate, some super simple math lets us get a quick and dirty estimate of what the annual inflation premium over the next 5 years is expected to be. And so this is what's called the 5-year break-even inflation rate. And all it is the difference between the interest rate on the tip security and the interest rate on the equivalent 5-year standard treasury note. And so you can see here is that right at the beginning of the pandemic, again, technical difficulty there was a decrease in expected inflation over the next 5 years. But then post-pandemic, as the economy recovered and there was lots of monetary and fiscal stimulus, the expected inflation rate rose. But then notice here, in about the last 6 months, give or take, it's declined somewhat. And this is interesting note here. This is based on the consumer price index. So that's how the cash flows are adjusted by the CPI. And so based on this, the expected CPI inflation rate over the next 5 years is about, rounding a little bit here, about 2.5%, give or take. And since the CPI tends to be somewhat higher than the PCE inflation rate, that suggests that the PCE equivalent, roughly, is around 2%, give or take. And so from the Fed's point of view, this would probably count as well anchored. So quick summary here, we looked at a number of ways to measure inflation and expectations. It's important here that economists and financial market folks don't look just at one or just a couple measures of inflation or expectations, because you want to get a broader picture here. And the idea is that any piece of economic data, including any piece of inflation or inflation expectations data, they always have weaknesses. They've always got some limitations. So for example, the CPI, as we talked about, is relatively narrow, and the basket of goods and services changes relatively slowly. It doesn't, or it may not, accurately reflect actual buying behavior on the part of households. In another example, the Federal Reserve Bank of New York's inflation expectations measure, that's a survey of households. Well, some of the households might be relatively uninformed, and so they might have unreasonably high or low expectations of inflation, which might throw that piece of data off a little bit. So then in part 2, we'll take a look at inflation dynamics. In other words, aggregate demand and supply factors that were affecting inflation both before and after COVID. Thank you all very much.